When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Thank you so much. Coming to you from the ILG Financial Studios, this is Retire Your Way, the podcast that gives you straight talk and honest answers about how to achieve your financial goals through smart investing and careful planning. Glad to have you along with us today. We have some valuable information for you that could change your financial life for the better. My name is Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and the solid advice come from Dave Lopez, managing member and owner of ILG Financial. How you doing today, Dave?
I am great. Sure great to be back with you and with all the listeners today.
Yeah, it is a pleasure to be here with this podcast. We reach a lot of people and, of course, give out a lot of great information, too. Well, Dave, of course, the financial crisis that we're in right now goes on. Nobody saw this coming. At the first part of the year, everyone that I spoke with said, we're seeing pretty much nothing but smooth sailing ahead. And here we are now, just a couple months later, in the situation that we're in. This is sort of a black swan event because nobody really saw this coming. Dave, do the investment strategies that we used prior to 2020, have they changed? Do they still work today?
Well, that's a great question. We're going to spend really several podcasts over the next several weeks talking about that, and we're going to have some experts. We're fortunate enough to have Tony Parish. We'll talk a little bit about that today. There's no short answer to that question. What we really want to do is talk about different strategies, how they're designed to work, and then in these new uncharted economic times, we can talk about how we anticipate them performing in this environment. That's how you can go about making a sound decision as to whether that strategy is still a good fit for you or if it's a strategy you might want to consider as a tweak to your portfolio.
We had such good financial times there, and I think a lot of people were influenced by probably the two main human emotions, that would be fear and greed. And a lot of people just, we just looked in the rearview mirror and said, it's been good up until now, let's throw it all in the market. And, things can come to an abrupt end. It reminds me of a turkey. The turkey, is born and it eats all the feed it wants. It's strutting around in the barnyard. It's just having the greatest time in the world. And it really can't look forward. And it thinks it's going to continue like that. And then all of a sudden, October turns to November and things come to an abrupt halt. And the turkey has sort of a rude awakening. And I think about that in relation to the financial market and the people who are investing in it too. I mean, we thought these good times would go on forever, but here we are. Things have come to an abrupt halt. And I think that those people who were able to look ahead and have a defensive strategy are those who are probably more mildly annoyed than having life-changing events as a result of this. So as you said, Dave, let's talk to our special guest here today. His name is Tony Parish, and I'll let you take it from here.
Yeah, I sure appreciate that, Jeff. Tony's on the line, and before we bring him in, I am just so blessed to have him on the call with us and the podcast. Tony is the Chief Investment Officer for Alphastar Capital Management. He has been in the security industries for over 20 years, which is a big deal, right? We want to be talking to folks who have been through all types of market conditions, and Tony sure has. He's been on Wall Street for 16 years, and he jokes with me all the time that don't hold that against him, but again, I hold it to his credit, right? We want to talk to people with actual real-life experience in some of the market environments that are either coming or that we're currently in. As far as credentials, most of the folks don't even know these but alphabet letters, but they mean quite a bit, I assure you, and I consider anybody who's curious to Google them. The first, Tony is a CFA, that's a Chartered Financial Analyst. He's also a CQF, very difficult designation to get. That is a certification in quantitative finance, which means he is the numbers geek of number geeks. And to me, that's a hero as being a numbers guy myself. So with that said, said, Tony, thank you so much for taking time out of your schedule. I know in these difficult economic times, you are on the phone constantly, and to carve out time for us is certainly appreciated.
Thanks, Dave and Jeff. I'm happy to be here.
Good. So what we'd like to do today is I want to jump right into our call today and use you as a resource, not just for us, but for all of those listening. And we'll encourage everybody listening. The beauty of this podcast is if you have anybody you care about, that when you've talked to them, they're not sure of what to do or why they're doing what they're doing, take advantage of these podcasts. Share them with your friends. Let them listen to them. Have them call our office if they want some advice based on their particular situation. Now, with that said, today, here's what we want to talk about on this podcast. A lot of folks have heard, and some haven't, have heard of things like investing in bonds, investing in investment grade bonds, investing in high yield or junk bonds, things like that. But they don't know much more than that. One of the things we talk about with our clients as one of many strategies, but one that we utilize at ILG Financial and Alphastar as well, is a bond ladder strategy. And we can use different types of bonds in that strategy. One of the strategies we use, and what I'd like to talk to you about today, Tony, is using a high yield bond strategy, a laddered bond strategy for some of the monies that clients would ideally like a little less volatile possibly than equities in the market, that can give us some income stream or some interest stream over time, but has a lower downside predicted. I know very well we can't guarantee this stuff. So let's spend some time talking about a high yield bond ladder, kind of how it works, and more importantly, if things get very bad over the next 12 to 18 months with the economy and the markets, how do we predict something like this would perform? So does that sound good to you, Tony?
That sounds great. Let's jump in.
Okay, so why don't you give us just a very brief explanation of how maybe a bond ladder, which is what we like to use with our clients, would differ from saying just going out and buying a couple bonds on your own or buying what a lot of folks are in, which is a bond mutual fund.
So the idea of a ladder is it is laddered throughout time. And what I mean by that is you invest in some bonds that are going to mature, let's say in 2020, others that will mature in 2021, others that will mature in 2022, etc. So if you have a high, let's say a 5-year bond ladder, you have a series of bonds that will mature over the next 5 years. Why is that important? It's important because when interest rates go up and down, that can really affect the prices of bonds. However, if you hold those bonds to maturity, and assuming they don't default, investors basically get 100 cents on the dollar back. They get par back. So what the bond ladder does, if you're holding to maturity, is it eliminates the interest rate risk that is normally affecting the returns of the bond market. The way these differ from individual bonds or from mutual funds is that with individual bonds, you're very vulnerable to any kind of downgrades or defaults of the issuer of that bond. For instance, if you owned Enron bonds back in the early 2000s, we all know what happened to Enron. Those bondholders experienced defaults. There was a loss of principal. If you invest in one of the bond ladders that we use at Alphastar, and Dave, I know that you use as well, these are essentially bond ladder baskets that are comprised of many bonds from many issuers in a single ETF fund format. So what that does is all of the bonds in that basket mature in the same year, and because they include so many different issuers, the downgrade and default risk associated with any individual issuer is minimized. It's reduced to a very small risk, which of course is good. The way that these differ versus mutual funds is with these bond ladders, you're really buying an exposure to a basket of bonds, a specific basket that will mature during a specific year. The way that differs from mutual funds is with mutual funds, since they don't have specific years in which all of the bonds mature, and since they have investors that are coming into the fund and out of the fund, the mutual fund manager has to go out and essentially buy or sell bonds on the fly to accommodate inflows or outflows. Why is that important? Well, it's important because let's say you like the strategy today, the mutual fund strategy today, but then it gets very popular and a number of new investors come in. The bond manager has to then go out into the market and buy more bonds to accommodate the inflows. And there may not be enough bonds that manager likes. So the manager would then have to start relaxing the screening criteria and essentially bringing in bonds that may not be optimal for that strategy. In other words, there's a dilution of the value as investors come in. The opposite is also true when investors go out, especially at times like this when the market is very volatile and there's forced selling that's taking place. The manager may have bonds that they want to sell, but are not able to get good bids on those bonds. So what they have to do to accommodate the outflows is sell bonds that they didn't want to sell. And once again, that reduces the quality of the experience for investors who are remaining in those mutual funds. The good news is the bond ladder, since you're owning a specific group of issuers for a specific period of time, inflows and outflows do not have the same impact as is the case with mutual funds. So I think they're just a much better vehicle to get exposure to the high-yield bond market.
Yeah, that's a great point, Tony. In particular, one of the things that folks miss, and this is really one of the things we want to shine a light on today, is when I have looked at hundreds and hundreds of clients' portfolios, and a lot of times what they will do is very easy to just lump ideas together, like, oh, I've got 40% in stocks and 60% in bonds, and I hear that's pretty safe. They have no concept of the idea that it is your exposure to bonds using just an individual bond or a mutual fund is completely different than your exposure if you use something like we're using, which is exchange-traded funds, buying batches of bonds and not mutual funds. And one of the things I wanted your comment on is you talked about what if people panic, because we're seeing that today, aren't we? What if people panic and they want to get out of a mutual fund that's in bonds? Your point was, and I want to reiterate it, is the fund manager may have to sell bonds that he doesn't want to sell. He thinks it's better for the investor to hold these bonds long term, yet he has no choice. And I think, isn't that called a right of rescission, Tony, that with mutual funds, if somebody wants their money, the company has, I believe it's 10 days, isn't it, to get that money back to the investor, which means the money manager has no choice but to sell bonds. So the guy who's not selling, who's been told to buy and hold, we've heard that our whole life, he's actually getting burned because his assets are being sold maybe at a loss to create cash for his neighbor who's panicking. Did I get that right?
Yes, you did. And different funds have different restrictions and guidelines and responsibilities with respect to honoring redemptions from their investors, from their shareholders. So some have more time, others have less time, depending on what the specific documents say. But you got the concept absolutely right. In fact, we saw a couple of weeks ago in mid-March, stocks were selling off and also U.S. Treasuries were selling off. Anecdotally, we know that investors were selling out of stocks because they were concerned about the potential fundamental impact to the companies that issue the stocks. But that's not why they were selling treasuries. They were selling treasuries because they needed to raise cash, and treasuries were a solid, liquid area of the market that they could easily sell in order to raise cash. In other words, treasuries were selling off not because investors believed that they were bad investments. They were selling off because that was just one area of the market that continued to function properly while other areas of the market were experiencing liquidity problems.
That's the voice of Tony Parish of Alphastar Capital Management. You're listening to Retire Your Way with Dave Lopez. We'll take a quick break and be right back with more after this.
You're one step closer to learning what a customized retirement strategy can do for you. Stay tuned for more of ILG Financial's Retire Your Way podcast with Dave Lopez.
Are you concerned about running out of money in retirement? Hi, this is Dave Lopez, managing member of ILG Financial. We want to show you how to avoid the simple mistakes and common misconceptions that can jeopardize your retirement. At ILG Financial, we think differently about retirement planning and think you should too. We'll start by helping you understand how your money works so you can feel more confident about your finances. We'll help protect what you have and explore growth opportunities without taking unnecessary risks with your nest egg. We'll be transparent and shine a light on your biggest retirement expenses like taxes and hidden fees. Call us today to schedule your complimentary review at 540-720-5656 or go to ilgfinancial.com and download a free copy of our Little Red Book of Retirement. That's ilgfinancial.com.
Investment advisory services offered through Alphastar Capital Management, LLC, a registered investment advisor. Alphastar and ILG Financial are independent entities. Income, legacy, growth. It's all right here at ILG Financial. And it's about helping you plan for retirement your way so you can achieve your financial goals. Call ILG Financial at 540-720-5656 or go online to ilgfinancial.com to learn more. Now back to the Retire Your Way podcast with Dave Lopez.
Welcome back to Retire Your Way with Dave Lopez. From the ILG Financial Studios, we're talking with Tony Parish of Alphastar Capital Management.
Thank you, Jeff, and it's good to be back here after the break. And I want to jump back into where we left off, Tony. We were talking about, and I think the takeaway I'd like our listeners to take away from this, and if you can give me a comment on it, is that most folks have no idea that if they think they have a little bit of a safer exposure, if that's their expectation by having bonds as opposed to stocks, they have no idea that it is completely different having exposure in a bond mutual fund than it is in having exposure in something like we provide at Alphastar and ILG, which is a laddered bond strategy using specific types of exchange traded funds. So one of the things I would suggest for the listeners, if you do have bond exposure, re-listen to this podcast and some of the things that Tony mentioned and ask yourself, do you know what the restrictions are for the money manager that's managing your mutual fund? Do you know when they have to get out and when they have to supply money to an investor who wants it? How's that going to affect you? And if you're not sure about that, I will encourage you to investigate with us these bond ladder strategies we're talking about, because they're very different, and we can address all of those concerns and how this can protect you as someone who's going to hold for the long term, as opposed to a mutual fund where you possibly could take a hit just because other people are panicking. Would you say that's accurate?
Yeah, I think that is accurate, Dave. Not all bonds are created equal, and not all bond investment vehicles are created equal. It really is important to make sure that you understand the risks that are embedded in any of the investments that you hold. And Dave, I'm sure you do a great job discussing those risks with your clients.
Yeah, I appreciate that. So what we want to talk about for the remainder of this podcast is this idea of this bond ladder that we use and how it's so unique to something as opposed to someone who just has an option of buying individual bonds or bond mutual funds. And one of the ideas I'd like to address is that with these specially designed exchange-traded funds, unlike mutual funds, they do not have this obligation that if somebody wants to get out of the fund, that they have to supply money to this investor, that they have to sell bonds. And that changes the whole game when we're talking about using this strategy to avoid interest rate risk, which you discussed earlier, and how we can set this strategy up that even though there's volatility in your account with the market and with panic, how we can at least get rid of interest rate risk if we're going to exit this strategy as designed over in a 5-year bond ladder over a 5-year period. Can you speak to that?
Sure. Well, so it goes back to the technical concept of interest rates and bond prices. When interest rates go up, bond prices go down, and when interest rates go down, bond prices go up. Why am I saying that? Well, I'm saying that because interest rates are always fluctuating. They're always moving up and down. And if you look at the price of your bonds, the price of that bond will move inversely to the direction of interest rates. But when you own a bond all the way to maturity, and assuming there's no default on that bond, which is a significant concern, especially in this type of environment, but I don't want to overstate that. When you own the bond to maturity, you're really eliminating the interest rate risk, because rates can go up and rates can go down and rates can go sideways, and the prices of that bond on paper will fluctuate. But the only thing that's important is on the maturity date, does that issuer provide the principal back to the investor, to the lender, in this case to the client that is invested in the bond ladder? And if the issuer is redeeming the principal back to the investor, that means that investor is going to get 100 cents on the dollar back. The bond hasn't defaulted, all the principal comes back, so all of the interest rate moves have been essentially irrelevant to the return of that investor, to the experience of that investor. So that's really important to keep in mind. Owning a bond ladder, and specifically owning bonds to maturity, eliminates the interest rate risk risk that's associated with owning bond mutual funds. And that's something that's really important for investors to keep in mind.
That's right. Even if you have a mutual fund, even if your plan is to hold your mutual fund over the long term for your bonds, that in no way guarantees that you're going to avoid the interest rate risk, because inside that mutual fund, bonds, whether you know it or like it or not, are being bought and sold, which means those that are being bought and sold before maturity are subject to interest rate risk. So one of the things we tell our clients is that for any strategy you use, any investment tool, know the goal before you get involved. Understand how the tool works. No different than if we were building a shed, right? Before you pick up a hammer, let's learn how it works, right? And let's use it for its appropriate purpose. So the advantage we see to this laddered bond strategy, and we tell folks, is, listen, what makes this work is you understanding it. And that's, of course, what we're here for, right? To help you through that so that you don't get spooked if your account goes up and down because of temporary interest rate risk. The takeaway with our bond ladder strategies is if you use them as they're designed to be used, which is, as Tony said, holding each bucket until it matures so that you get full value back plus the interest you've accrued, with the exception of default risk, which is the only remaining risk really in that account. If you use that bond ladder that way, so on a 5-year bond ladder, the example would be, we tell our clients, hey, be prepared, if necessary, to take your money out of this bucket 20% a year over 5-year intervals. That way we can, if you're willing to do that, we can guarantee to avoid interest rate risk, and that leaves only default risk. Wouldn't you say that's accurate?
Yeah, I think you summarized it well. Another thing to add to that is many investors who want to own bonds over the long term, that they believe it's an appropriate part of their asset allocation strategy, they may put in place a 5-year bond ladder. And then when the current year's bonds mature, resulting in cash, they simply reinvest those bonds in another group of bonds that will mature 5 years from now. So essentially what they're doing is creating a rolling 5-year exposure to the bond market. Why is that important? It's important because A, you're eliminating the interest rate risk because you're holding all the bonds to maturity. And B, if interest rates go up, the new bonds that you'll be investing in at the end of this year will have higher coupons, higher income levels that are consistent with the current interest rate environment than the ones that are maturing. So what this essentially does is allow investors to scale up the interest that they're receiving if interest rates go up, while minimizing or reducing the amount of interest rate risk that's embedded in the strategies that they own. So it's a good way to get exposure to bonds over the long term while reducing the interest rate risk associated with investing in bonds.
Tony, great point, right? And we're running out of time, so I would encourage you, if this is of interest, reach out to us and we can talk about them and how they might specifically be a fit or not a fit for you. I love this idea, which we just got into on the end there, of using a laddered bond strategy to benefit if down the road interest rates go up. Because the reality is you've watched interest rates go up and down over 25 and 30-year periods over time. You can go all the way back to 1956, and from 56 to 82, interest rates went up, right? Most of us remember getting a mortgage for 18% in the 80s. And then from 82 to roughly 2003 or 2004, down, and they've been down ever since, right? At historic lows. So we're at unprecedented territory, unprecedented lows of interest rates. And eventually, if your bet, and this is our bet, eventually interest rates will start to turn and go up. And we believe when they do, it'll be just like before, over a 15, 20, or 25-year window. Well, imagine if that happens and we have put you in a laddered bond strategy. So every year, as a laddered bond bucket matures and turns to cash, we're reinvesting it in another bucket at higher interest. And we just ride your interest rate up over a 20 or 25-year period. It's a great fit. I encourage you to talk to us about it and let us articulate the advantages and the disadvantages so we can make a decision that's in your best interest.
Thank you so much, Dave. And once again, if you have questions about anything that we've spoken about here in the show today, you want to talk to Dave Lopez about your individual situation, call 540-720-5656. That's 540-720-5656. And once again, check out the website, ilgfinancial.com. I want to thank Tony Parish for being our guest from Alphastar Capital Management, and I think Tony's going to be back with us again next week. For Dave Lopez, I'm Jeff Shade. We'll talk to you again next time with another edition of Retire Your Way.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of Alphastar Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alphastar Capital Management, LLC, an SEC registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. Alphastar and ILG Financial, LLC are independent entities.